Hello, everyone. Thank you very much for tuning in today to the latest Bridging and Commercial virtual roundtable. This time we are doing this in partnership with InterBay Commercial. My name is Caron Schreuder. I'm the Managing Director of Medianett, and we publish Bridging and Commercial as well as Development Finance today. I'm very, very happy to be hosting this session today with Emily Machin, which is Head of Specialist Finance for OSB. We've also got three brokers with us, specialist experts who will be providing the intermediary perspective on our topic today, which is all about semi-commercial mortgages. I will shortly let them introduce themselves. Just a reminder to our audience, we encourage questions to be asked throughout. You've got the option to do this via the GoToWebinar dashboard. You can raise your hand there and put a question to our panel. We'll try to get to as many of those as possible. A short introduction to today's topic. It's definitely not something that we cover as extensively as I think we will do in the coming months and if not years. But there has been a lot said of late about the evolving world of landlords and buy-to-let in general. Changes have been brought about by the pandemic, as with any other industry, but also long before 2020 in the way of taxation and regulation. It's meant that the average property investor has had to rethink, reconsider, or strengthen their position and their strategy to ensure that it's sustainable and that they have longevity of income. The opportunities that have emerged out of this sort of necessity and demand have included holiday lets, HMOs, and of course semi-commercial or mixed use, as it's also known. These rental properties combine an element of commercial use with residential. So think, for example, your typical high street, or what was once a typical high street. That's perhaps another area of discussion for today, but with flats above shops or pubs with self-contained accommodation. We'll be discussing the upsides of moving from operating and investing in a standard buy-to-let into the sector which incorporates commercial aspects, and the considerations that need to be made in connection with the business element. As with any step up, which is what we're referring to semi-commercial as in relation to standard buy-to-let, loan structures do get more complicated, and it is all about selecting the right broker as well as lender to be your finance team for you and your client to make sure that this transition is as smooth as possible. In commercial, semi-commercial properties have remained Knowledge Bank's top searched for term for 14 consecutive months, bar one, indicating that brokers have been turned on to this topic for quite a while. And it was recently described to me that this product area at present requires a similar level of education building in the market as bridging once did, which we're excited to be a part of that journey to raise awareness of the product, alongside InterBay, a business which is definitely making a concerted effort to prioritize its offering in this space. So I feel like I'm in very good company to hash this out today. So I'm going to hand over to the panel to briefly introduce themselves, and I'll start with you, Emily.
Thank you, Caron, and thank you for hosting us today. My name is Emily Machin, and as you said, I'm Head of Specialist Finance, which covers InterBay, Precise, and also Kent Reliance. I think the topic kind of today, the next step on from semi-commercial is really topical, and obviously you've highlighted that with the Knowledge Bank search. But also from my perspective, working for a lender, I think it's really good that we've established a great panel of people here today to discuss kind of whether they agree with that and sort of get their thoughts on that as well, which from my perspective, I'm going to find really valuable.
Thanks, Emily. Jason?
Hi there, so I'm Jason Perry. I'm Group Sales and Marketing Director at Crystal Specialist Finance, so we're based in the West Midlands, and yeah, delighted to be here today talking all things semi-commercial.
Thanks, Jason. It's good to have you on again. Lucy.
I'm founder and MD of Vantage Finance. We're a specialist master broker dealing with all things property finance. We're 17 years old as a business, and we've worked with the challenger banks, high street banks, and pretty much the whole market for semi-commercial alongside other things for many, many years. So it's something that I'm quite looking forward to having a chat about.
Thanks, Lucy. And Matthew.
Yeah, my name's Matthew Rowne. I'm Director of multi-award winning national mortgage brokerage, the Buy-to-Let Broker. We were established in 2013. We've been fortunate enough to sort of achieve record growth quarter on quarter since then. Really, we transact about 40 million a month in terms of specialist finance, and that's very much around the specialist sphere, whether that's sort of buy-to-let within limited company structures in corporations, or specialist securities like multi-unit freehold blocks, HMOs, or semi-commercial, as we're here to discuss today. And more important than all of that, I'm a husband, a father to 3 wonderful children who continue to shape me every single day. And yeah, you know, I'm excited to chat about this. We're key partners, as Jason and Lucy are, with OSB and InterBay, and you know, they're leaders in being innovative in that field. So yeah, looking forward to today.
Thanks a lot, Matthew. It's good to have you here as well. We've got same people on some of these roundtables, and I like to hear your different perspectives on the different topics. So welcome back, and let's launch straight in. Emily, when we were coming up with the topic for this, you guys described it as a step up, and I think this is important to expand on so that people can understand why this represents as an evolution of standard buy-to-let, and why you would view it as such.
Yeah, no, absolutely. So I think historically we've always sort of talked about landlords diversifying their portfolios, and I think again a couple of years ago that probably meant going to a HMO, you know, from a standard buy-to-let, or you know, a couple of buy-to-let portfolio going to HMO. Now with obviously the COVID situation, the lack of stock that we're dealing with in the market, more and more lenders offering semi-commercial proposition, it does feel like there's been kind of a shift, I think. Historically, landlords probably were of the opinion that actually semi-commercial is complicated. You know, they don't want to kind of take that step, but you know, the situation's changed. You know, we've all been through the last couple of years, and it now seems from a lender perspective that we are seeing a lot more semi-commercial, and it comes from landlords who are experienced in buy-to-let already, maybe have a couple of HMOs, maybe not, but actually now looking to see, you know, how can they sort of improve their overall portfolio by branching into semi-commercial. And now, obviously, it kind of does come with a stigma that doing commercial lending is complicated. And again, that's one of the reasons why we work with Crystal, Vantage, and the buy-to-let broker, because we know that those guys are experts in their field and provide a kind of really nice middle ground, really, to build a good relationship between client, broker, and lender.
Thanks, Emily. Lucy, what do you think is driving this? Is it something where the landlord market has changed and it's dictating what's available out there, or is it that the lender appetite in the market for the product has changed and then it's giving more options to landlords?
I think it's demand driven. I think that there was a real lack of sensible products in the market for semi-commercial. What we've seen over the last, it's probably been really 10 years, that the high street banks are just not there to support commercial and semi-commercial investment. You get customers that come to you and they want really sensible interest rates because they've got a good tenant in, it's been let for years. And okay, we might get them a sensible interest rate, but it's also 50% or 40% loan to value, which that just doesn't work for investors. It's, you know, they can't drive a portfolio that way. It's too capital intensive, and therefore often the two main requirements are loan to value and interest only, and they're two things that the high street banks just don't provide. So I think there was a definite shake up over the last 18 months where even the challenger banks have said, oh, hold on a minute, are we comfortable with this asset type? And we saw lenders retreat, or certainly become a lot more, what's the right word for it, perhaps a bit more aggressive in the way that they underwrote those deals. However, since then, I would say that there's a realization that you have to be in the market for what landlords want, and if that's the direction of travel, there's no point in saying, well, we don't do that, and allowing somebody else who is perhaps going to design a product around what the demand is dictating, have all the business. So I think we've seen definitely more competition as a result of the demand, but it's from my perspective, I think it's definitely demand driven.
And I think that landlord profile is interesting as well, isn't it? Because I think we've almost got two types of landlords that we're seeing. So we've got the amateur landlords who previously maybe only operated in the that buy-to-let space, but have now, through to probably necessity, they've matured their own structures. So they've got a limited company around them, and they've got ambitions, and they've got a framework which enables them to be a bit more expansive with their portfolio. So I think there's a structure that they have which encourages diversification. Then you've got the serial professional landlord who is probably always going to want to to take advantage of the semi-commercial opportunities, but I suppose they're increasingly just exploiting the change of use and the permitted development rules, which I'm sure we'll talk about later in the conversation. So we see two very distinct and different landlord profiles, but they're showing huge appetite at the moment despite the lack of stock.
We've actually seen.
Sorry, go on, Lucy. No, go on, Lucy.
We've actually seen more amateur landlords turn their hand to semi-commercial. I don't know about you guys, but way more than we ever used to.
I mean, I echo your thoughts from earlier. It's very demand driven at the moment, but certainly from our perspective, it is more the experienced landlord. In terms of whether it's a step up, I think the phrase, it's clearly got a lot of advantages, semi-commercial security over sort of standard dwelling security. Caron alluded to the myriad of sort of governmental and sort of regulatory changes over the last 5 or 6 years, and it's driven landlords towards searching for additional yield. The increase in property prices across much of the UK over the last sort of 5 years before we had the sort of buoyancy of the last 18 months, again, has led to higher cost of assets, lower yields, and so landlords are continually searching for that. Aside from that, and we don't give any tax advice, but semi-commercial security can often be an advantage from a tax perspective. They've often got longer lease attached to the commercial element, allowing for long-term planning for landlords. Whether it's a step up, I don't know. I'm a great believer in diversification of any business is essential to remain robust long-term, and that includes property. What it is more complex. So I do think it's the domain of the experienced landlord. I do think just the additional due diligence required up front when sourcing a security, the depth of advice required in terms of financing or leveraging that asset, assuming you're not extremely experienced. And as Lucy said, the high street doesn't have the appetite of the specialist lenders such as InterBay, especially at the higher loan to values or where they don't want an element of amortization. And I think there will always be legitimate exceptions to the rule. There will always be high quality, high net worth clients that fit within our demographic where you could have an inexperienced landlord looking at semi-commercial, but I do see it as very much sort of the domain of the experienced landlord who wants to diversify and wants to grow their portfolio. And also it's a nice stepping stone sometimes for those landlords that want to diversify fully into full commercial, but aren't yet comfortable with that. And I think semi-commercial provides that opportunity as well.
Thank you for that. That provides a really nice backdrop to some of the more detail-driven areas we want to talk about. I wanted to just, before we go any further in the conversation, Emily, would you be able to just run us through some of the differences in the underwriting process for semi-commercial loans versus those of a standard buy-to-let? And I'd also like to just chat a little bit about the ratio of how one decides whether something's semi-commercial. It seems like there are different ways to assess that from an lender point of view.
So one of the great things about InterBay is that we don't mind what the split is between the residential and commercial, which is always a big question, because some lenders will say, if it's a certain percentage, then we're classing it as commercial or whatever the ruling. So at InterBay, we don't actually mind, which makes the underwriting probably a bit easier for us. We still need to know what the split is. because that's all about how we risk weight it in, behind the scenes, doesn't sort of impact the customer. So we do need to know what the percentage is, and that's probably, again, I know we're going to talk about this in a bit, but that is the biggest question that we need to know. Obviously, we are dealing with two different types of asset classes, so the commercial bit on the bottom and the uppers. So we are going to need to know the lease agreements on both, and whether we've got ASTs, whether it's a HMO on top, what are we dealing with? The same as in any standard mortgage, what are we being asked to lend on, and how good is the security, and how good is the client? So there isn't, because it's semi-commercial and it's not full commercial, there isn't masses of different in underwriting. So from our perspective, it's not that much more complex than kind of our standard underwriting. Given the size that we are, we have to pretty much do the same for each customer, whether it's a residential loan or whether it's a full-on commercial. We have to do our money laundering checks, we have to do this and that. So the process is very, very much standard, but I think as long as we can be clear on what the commercial is, what sort of lease is in place for the commercial, and what have we got going on with the uppers, then that that kind of nails it for us, really.
I think where Landbay are scoring, or OSB scoring particularly well at the moment is, I suppose, the three of us, from a distribution broker perspective, we just want certainty of decision, and we crave that more than anything else. So, pricing's important, LTV is important, but absolutely knowing that we can place and get that case administered and completed. There's a confidence we've got with InterBay at the moment, but you can overlay, we've also got some really strong pricing, which now starts with with a 4 rather than the traditional 5, 6, 7s you've seen in the marketplace. So I think that certainty of decision is certainly something that we take away from the relationship with the OSB brands at the moment.
Yeah, Jason's hit the nail on the head though. It is very lender specific, and InterBay will be much more efficient in their underwriting than much of the high street banks. But there is a difference in underwriting. I mean, on a really obvious level, up to 50% of the security is a commercial security, and so that has to be underwritten differently. The residential side, the uppers, as Emily called it, is normally generally underwritten much the same, although you actually might find more leniency on the tenancy type, because by the very nature, semi-commercial lenders are more comfortable with commercial and longer term tenancies. But lenders will want to look at commercial lease, and whereas on a standard buy-to-let, if you want to compare it to it, the type of tenancy is looked at rather than the type of tenant or the quality of tenant. With the commercial side, the lenders will want to look at the commercial tenant. Is it a blue chip company? What type of industry it is? If it's a gym or a public house or a place of worship, they're generally not going to want to lend on those type of securities, or if they do, it'll be very much reflected in the rate. If there's an element of trading business in it, lenders will generally want to maybe look at company accounts or 6, 12-month bank statements, etc., and how that's established. On a really basic level, the flat above does have separate access. Obviously, that kind of thing isn't needed to be looked at in standard buy-to-let. That will be looked at by lenders. And generally, the location is important for the commercial aspect. Is it an area that's saturated with less demand? If a buy-to-let is vacant, whether it's a purchase or a remortgage where the tenant's moved out, buy-to-let lenders don't care. Commercial lenders will generally want to see a sustainable and viable business tenanting that property. They'll want to look at the terms of the lease. They'll want to look at break clauses potentially. They'll want to look, is it an FRI lease? There's lots of aspects to commercial lending that a specialist broker will be able to add value to. And whether it's going to a high street lender or real specialists in the market like InterBay will be determined sort of how that's underwritten. But I think that's to the broker's advantage. I think it's the landlord's advantage. And I think when a case is presented right, something where the high street won't particularly have an appetite at this stage, even though the security and the landlord or the client is strong, lenders like InterBay are leading the way, and you can get access at 70% loan to value, whereas, as Lucy said, most of the high street lenders are capping out around 50, 55 much of the time, depending on the security and wanting amortization with that. And it is capital intensive. It does stop leverage. And landlords are trying to achieve a higher yield, but they don't want to do it if it's going to be offset by such requirements to put down huge elements of capital.
One of the other key things here is that the majority of leases now are sub 5 years. We don't come across very much at all where a lease will be in place for 10, 15 years. We do occasionally, but the majority are local leases, maybe 2, 3 years left on them. That does really rule the high street out entirely. So you're in the challenger bank space, and that's what InterBay understand and can really get their heads around. But obviously part of the key here is how much demand is there. So if you've got a tenant in situ, depending on how long they've been in place, is it over rented, is it under rented, is it let at the appropriate amount, and what's the demand like? Because if you've only got a year, 2 years left on the tenancy, the property team, they're always going to say, well, if they leave, who comes in next? And it may well be that tenant's been in for a while and they agreed their rent when the market was a bit more buoyant for retail properties, if it's, you know, a shop with uppers. And the valuer might say that if it was to be relet, it would be relet for less, and therefore InterBay are going to be therefore nervous about working off of perhaps the higher rental, depending on when that lease comes to an end, or whether the tenant's engaged about a new term of lease if we're coming right towards the end, and also what sort of incentives would you have to put in place to attract a new tenant? Do you have to give 3 months, 6 months rent free? Tends to be less if it's just a small retail unit. If you've got a slightly bigger office building, quite often in certain areas they'll want 6, 9 months rent free, and there are all sorts of considerations from an income perspective, and what impact that then obviously has on knock-on effect to the valuation, because in nearly all scenarios with the challenger banks, they are working off of vacant possession value too, rather than investment value. So those are all considerations that we try and get sort of to grips with before we even start talking to a lender, because you can't leave any of that to chance.
Yeah, it's a really valid point, actually, and one of the reasons why we have our real estate team in-house, who can kind of give us that sort of market background, that experience from what they're seeing in terms of how well an asset might perform. The good thing with semi-commercial is that having the flats above, or the uppers, or whatever term we want to use, gives us a bit of added comfort. So it can kind of allow us to be a bit more flexible on the commercial elements. If, for example, the lease may only have 6 months left to run, or it's a new tenant, they've only been in for a couple of months, we can kind of sort of give some flexibility if we've got really strong securities on, above the actual shop, which can help achieve the loan to value and the loan amount that the clients want.
Yeah, if the rent covers the payment, even if it doesn't give you the debt service cover that you want, if the rent covers the payment, we would always put forward the argument to say, even if they did need to find a new tenant and there was a gap, that they're not going to be underwater at least. I mean, if you did that for a sustained period, they might be, because you definitely want more than 100% cover. But if it's just a case of that tenant leaves, you find a new one and you have a 3 month, 6 month gap, the rental from the uppers gives some comfort, at least, that the mortgage can be paid if for any reason the customer couldn't pay it from their outside income, which sort of is another subject altogether.
Emily, are you seeing a trend in relation to whether these loans are being taken out on an owner-occupied basis or on an investment basis? Is there a sway which way this is going at the moment?
No, I don't think we're not probably seeing a trend to one or the other. We do both. So I mean, looking at the business we've done recently, I'd probably say it was more investments, because I'm not always sure whether people, with their own businesses actually know that they can potentially buy the property, that they operate out of within, and keep it within their company. I think we've literally just done a couple of pieces on it, really, because I think it's kind of the next thing that we should be talking about from a sort of commercial, semi-commercial basis.
Okay. Jason, we've just been talking about a lot of the sort of considerations to be made but we're also coming out of a time of immense flux when it comes to businesses' viability, especially when we're talking about the high street, which I alluded to in the intro, that things have changed immeasurably there, and thus they should probably change the landscape of semi-commercial to an extent. What are your views on this, and how have you found lenders responding to this volatility?
Well, look, I mean, I always think lenders can do more when it comes to being expansive with with the criteria. And look, I think expansive criteria and increasing LTVs and showing a bit more appetite on criteria doesn't necessarily mean that we're taking on more risk. I think we've just had an environment and a circumstance which is an absolute event and a life-changing event for many people. That doesn't mean that those people become poor payers or bad risks overnight. I think in my experience, the persistent poor payers are in a debt spiral that they'll never get out of. I think the environment, as I've said, we've been in over the last 18 months is going to see pristine and absolute category A borrower profiles who might have a little blip on the landscape, or it's caused by something that's been outside of their control. So I think there's a real collaboration that needs to take place between lenders and distributors like ourselves to ensure that the shaping of criteria, the shaping of the solutions, because we're all focused on customer outcome, is a real good conversation. So I think the days where lenders can maybe lift and drop products onto into the marketplace, I think are long gone. So I welcome collaboration with the lenders. We've got a mountain of data that we can share with them, and I think between us we can really deliver some amazing solutions over the next 3, 4, 5 years. Because let's have one thing right, the next 3, 4, 5 years is going to be an amazing space for the specialist marketplace to operate, but we need the solutions to be able to fulfill those outcomes.
I agree entirely with Jason. I think, but it isn't just criteria. Lucy alluded to the fact a little earlier about sort of putting forward an argument to a lender where debt cover ratio was 100%, and I think it's about away from the high street where criteria is much more binary. I think with all specialist lenders, and I keep saying this, and I would say it because obviously we're specialist brokers here, and Emily's a specialist lender, so clearly that bias is there. But the reality is those specialist lenders, when the case is presented right and packaged right by specialist brokers such as Lucy's and Jason's operation, and obviously ourselves, allows lenders to make that common sense judgment on it. Have businesses been impacted by COVID? Of course they have. So many industries have been hugely impacted. We're just lucky enough to be in a bubble where our industry hasn't really been impacted to that degree. But I think the important thing is that if a broker or a client or both are inexperienced, then a case can be presented to a lender where turnover has dropped, where profit has dropped, where margin has decreased, where government assistance has been used continually, and lenders will be reticent potentially or conservative in their approach towards that. If the lender and the broker works closely together and the applicant is able to do that, then common sense can be achieved from a lender perspective. Why has that business had the drop it had in COVID? What changes have they made to operations to enable them to now change that and to make sure they're more agile going forward should we hit further lockdowns? Was that government assistance used as support during the period, or is it the only thing that's kept the business afloat? Can we provide, if last year's accounts are low due to the COVID pandemic, but things have changed, and can we provide up-to-date management accounts? Can we provide up-to-date bank statements? Anything that will provide the lender comfort. If we can provide clarity to the situation, then in reality, the underwriters at specialist banks and the challenger banks are going to get very comfortable with that, and they're going to be able to make decisions that benefit the client and benefit us as brokerages. And it's really, really, really important those relationships are established. And this goes back to when we said, is it a step up? It's just the domain of the experienced brokerage, the experienced landlord, who are able to paint a picture, move the opaqueness from an application, which, to be quite frank, otherwise it's a bit more like roulette, where lenders are trying to see if there's a case from the myriad of documents that's just not how it should be presented. But no, I actually think there's huge opportunities, as Jason said, in the specialist market going forward. And there's lots of businesses that have really come out of COVID strong, but we've just got to be able to present that in a way where a lender can say, yeah, we're comfortable with this.
Are there certain combinations of residential and commercial that will not work for this type of lending? So a specific type of business that it just doesn't make for the correct mixed use structure?
I was actually just about to say, Caron, that sector has never been more important than it has over the last 18 months or so, albeit I think, touch wood, we might be slightly coming through the other side of that now. Obviously anything that's hospitality, anything which was forced to close, non-essential basically, struggled massively, and that's where a lot of landlords wouldn't be paid their rent. I think the combination point is probably not relevant because you've got residential tenants and you've got commercial. They're looked at in isolation. So I can't remember who mentioned it earlier about sometimes there'd be a HMO on top. It doesn't really matter whether it's a HMO or a couple of flats, one flat. The split of income certainly does make a difference, because if you're then trying to rely on the residential income but the split is higher on the commercial side, then the lender's probably going to take a deeper look at who the commercial tenant is, and whether they've been paying, what the performance is. And with a lot of these local covenants, you don't get financial information from them, and it would be unreasonable to expect so. Most businesses, unless they have a really good relationship with their landlord, wouldn't start volunteering accounts at the type of target market that we're talking about here. If you start getting bigger, then there is an expectation that financial information would have to be shared, perhaps when agreeing the lease, but less so on an ongoing basis, depending on what they've agreed between them. But sector has obviously been vital, because there was a period of time where there were certain sectors that were near on impossible if they were in occupation to get finance for. You know, hairdressers were closed for the majority of time. You've got things like bars and pubs and restaurants, which have always been a little bit trickier. If you look at sort of drink-only pubs, they've been challenging for a long time. If there's an element of food as well, that's helpful. But then you've kind of got the takeaways and what impact that might have on the residential upstairs. So it's less of a combination, and I think it's probably more driven by the commercial itself, because if the lender's comfortable with residential, they're not too concerned whether it's self-contained units, HMO. If they do both, then the combination's less important. But looking at the downstairs, I think, has really been key. And obviously, as we go through these cyclical times and you see certain businesses struggle for whatever reason, and this is obviously unprecedented, so hopefully we won't see too much more like this in the foreseeable future, but the impact on those businesses and the speed of the shock versus normal times where you might have, okay, retail suffered for quite a while and there's been a bit of scrutiny on retail for some time, but it's been an evolution, because it's been market driven by consumer choices and how we all shop and live these days, whereas the pandemic was certain businesses that could have been hugely successful just overnight closed, and those that were fortunate enough to be able to pay their rent because they had reserves in place, great, but many businesses, small businesses, could not afford to continue to pay their rent. And then it's down to the landlord to either negotiate something with their lender or say, do you know what, I'm going to carry on paying regardless. And I think, again, coming back to that safety net of the residential really does help with semi-commercial, which makes it easier for lenders to transact there than it has fully commercial, which is why we've seen a bit of a downward trend on semi-commercial rates recently.
Just to add to that, again, you know, you've absolutely nailed it there. I think it's it's been great that we've been out of lockdown a little bit longer now, and we've really started to see some improvements. And actually, you know, yes, obviously unfortunately some businesses have been really badly affected, but actually those hairdressers, the nail salons, you know, they're all coming back, they're all trading again, they're all making the money. You know, yes, they've had that blip, but you know, they're improving things. And again, I think that's where specialist lending kind of comes into it, because you can have that conversation and say, well, you know, this is what they were doing before. Yes, COVID has had an impact, but this is where they are now. And actually all the reports we're seeing internally is that retail is, you know, overall retail and hospitality is doing a lot better than anybody actually anticipated coming out of the pandemic. The other thing I just wanted to add was just on the uppers, you know, I think you're right that, yeah, they're not as much as a risk, but I do think it's worth making the point that, you know, lenders are still going to care whether they are self-contained, whether they are HMOs, whether they've got, like Matthew said earlier about the separate access. You know, if there's no planning permission, if there's no building regs, you know, you're going to struggle to find a lender that is going to term that without you having the necessary, you know, regulations in place. I think it's just worth noting.
Thank you. I just wanted to move on to some of the changes that we've seen in relation to planning over the last sort of few months, year, where with the changes in the use classes as well as permitted development rights. I wanted to see whether this has any bearing on the semi-commercial market. I had also read earlier today about a sort of, they've called it a loophole, but where semi-commercial mortgages are being taken for properties, and then they're being converted into residential off the back of that, and this is a way to kind of circumvent some of the planning that might be normally needed for that. Just wanted to get the panel's views on all those changes. Matthew, any thoughts?
I mean, well, in terms of just that last point you raised, before we go into the wider point, you know, that might be a loophole in terms of changing the usage of the property and getting more residential dwelling, which was a stimulus for much of this change. But ultimately, that shouldn't be obtained on term funding, whether that's through a specialist bank like Interbay or not. That, you know, that level of development should be done on some element of bridging or development finance. And so again, you need the advice from the broker, because operating outside the terms and conditions of a lender's mortgage offer like that isn't recommended for a whole myriad of reasons. You know, the changes that have come about, you know, in both the use classes and in terms of the permitted development, they should be hugely positive overall. You know, and as I say, that the driver with the repurposing of buildings on the high street and getting more residential property out there, especially where commercial was struggling. They've revoked, you know, the A use class and basically broadly put an awful lot into E. The main challenges for the landlord, if you like, you know, when there isn't a change of use class, planning permission isn't generally required. So now you've got a situation where, you know, E includes, amongst other things, you've got retail, you've got sports and gyms, you've got restaurants, you've got all sorts. So now, you know, a property could legitimately go from a shop to a gym and back to a shop without planning permission in many areas. So there's going to be more due diligence required in terms of the lease from the landlord, especially if there's certain changes they wouldn't want made to the security. But you know, the idea is that it's generally a positive thing, and even with the changes to the permitted development rights, the local councils are still going to need to give permission on them, but you know, around the more general sense. But no, we think it's a hugely positive thing. I think it makes, you know, we've talked about landlords being more agile. It means securities can be more agile in terms of their usage. I think that makes them stronger assets for the long term for both landlords and potentially lenders. It'd be interesting. I think we'll have a lot of changes. I think even the interchangeability of assets, or the ability to interchange like that, will impact valuations. Will there be a more evening out of valuations because we're not attaching a valuation to such a specific use class? It'd be interesting, but I think generally it's all positive.
I think that, I mean, the fact it touches so many different asset types and securities is the exciting thing for me. So whether it's a, you know, rural barn that is all of a sudden going to be, you know, usually expanded in a greenbelt area, to your small little retail shop that's empty and sits in a nice position that could be easily converted into resi. I think there's so many areas that this can actually touch, and anything that obviously enables greater speed or reduces bureaucracy has got to be something to be embraced. And I think the challenge the three of us have in our individual businesses, it comes back to the point I think Lucy touched on at the beginning, it's this education. So we've got to have a really consultative approach with our broker partners, our distribution, so that they understand the benefits that are actually available, because make no bones about it, this is it's a huge opportunity. Irrespective of stock in the marketplace, there's huge opportunities to educate and inform and assist brokers so that they can actually help investors invest. So I think it's it's fantastically exciting, and I'm not sure in 10 years time how we'll feel when we look back and maybe see some of the developments in the greenbelt areas that I've touched on there. But make no bones about it, investors are actively looking at sites, and I think it's irrespective of stock in the marketplace, I think they will make things happen as we go through the next 15-18 months. But we've got to educate our core distribution so they understand and can advise it properly.
And you have to remember that the demand has to be there for the asset type in the area. So it's all very well and good being able to do it, but does the area actually demand it? Because there was a big thing around repurposing to residential and quality of accommodation, taking some retail units, etc. But actually the deal has to stack up. So Matthew was talking about, first of all, financing it. It's not really a semi-commercial mortgage, commercial mortgage, it's development or refurb. And there is a sense check at both point of valuation and also lender assessment, if nothing else, that says, hold on, you want to do X or Y with this property, but it's bang slap in the middle of all these other shops. No one's going to buy that. No one's going to buy it, and therefore there isn't a market for it. And I think that to a certain degree will slow down properties being transformed to something that it just makes no sense to transform them to. Obviously there'll be some people that can do it with cash or what have you, but most people are sensible enough to look at it and say, is what I'm doing actually, does it fit the marketplace? Is anyone going to buy or rent this at the end of it? So having the flexibility there is great, because it allows for really more than we've ever had, and the planning system has needed change, and it still does need change, but I think being able to change across the use classes is hugely beneficial for the market, because we're forever changing, aren't we? We're always seeing things adapt and evolve, and if you constantly have to go back in for full planning applications, and if you have challenges moving from one to the other, it just means that things don't evolve with the demand. And we've talked a lot about that demand today, and I think it's increasingly important. And really, it's only an exciting thing that landlords and investors do have that flexibility and can explore more options now, rather than being in a very narrow confine as previously.
I just wonder, Lucy, just what some of these smaller town centres are going to look like in 10 years. I mean, there's a couple of blueprints out there at the moment. I mean, I'm down in the Sussex now, but I'm originally from Manchester, and I was up in Altrincham, which is not too far away from where Matt is sitting now, I would imagine. And it's a town centre that's totally been overhauled. And I think at the core of it, you'll probably know better than me, Matt, I think at the core of it was redeveloping the market, which has then saw the empty shops, and it's become a bit of a hub spot for people to want to visit the market. So consequently, all these empty retail and office premises have actually gone through a very sensitive and a very tender reshaping. So I think that looks like it's an area which has probably, whether by design or default, the town centre has been totally redefined, and it's got positive outcome as a result. And I mean, you are close to it, Matt. I mean, Altrincham, 10 years ago when I was last there, it looked quite a distressed place. I don't know whether you were last there, but it's probably more recent than me. Could you see a town centre like that being the blueprint for maybe other town centres elsewhere in the country?
Very possibly. I think that the biggest thing is that we're continuing to evolve, and I think COVID, in many ways, if you want to take one small positive from it, it's accelerated a lot of those changes. You know, from people moving away from city centres as businesses embrace working from home or hybrid practices, for retail, sort of where maybe, as Lucy said, was already struggling over the last 10 years. You know, it's been the final nail in the coffin for much within retail. Is the demand there to change it to residential? Is it going to be different types of industries? But I think different towns will be used as a blueprint. You know, we've seen way before COVID, over the last 5 years, many clients within the M25 purchasing commercial units and converting them to residential. And the interesting thing is, once that gains momentum, you know, Lucy said an interesting point again, you know, where if it's one residential slap bang in the middle of commercial, is a demand for it. But once there's a tipping point somewhere, and once it gets momentum, people start looking at other commercial units and saying, oh, that would be good to convert through. I don't know. I think we'll see a lot of changes. I think COVID isn't going anywhere soon. You know, we may have hopefully got over the worst of it in terms of how it affects us all from a commercial standpoint, but it's not going anywhere, and I think it will change things, and I think a lot of things will change for the good as well as the bad, and we'll continue to see towns develop and adapt, and you know, it goes back to what we said, we've all got to be agile. Landlords have got to be agile, and if towns want to stay relevant, they'll have to be agile as well.
Just a couple of bits to add. I think the situation with the high street was always going to happen. It just COVID accelerated it. You know, we saw some of those larger kind of department stores starting to ship out, go bust, moving away from the high street. I think you're seeing kind of those big long-term established businesses tending to move to more the industrial parks, or the industrial, whatever you call them, where there's always the drive-through McDonald's, and so yeah, that is obviously leaving lots of vacant shops. It potentially can pave the way for more local businesses. You know, we're all about sustainability now. We're all about, you know, buying local produce and things like that. So it's returning to kind of the market sort of towns, as Jason said. In terms of like PDR and commercial to residential and all of that, I think we probably just need to be clear on, you know, yes, it can be done, but like Lucy said, should it be done? And secondly, you know, if you're talking about a shop and you want to change that to resi, that's fine, you can do it, but you can't change what the shop looks like. If you want to do that, then you have to get planning permission. So it's not as simple as just doing what the hell you like with it. You do need to be clear on what you can and can't do. And from a lender perspective, I would say, you know, as long as you're kind of upfront with us and you're sort of saying, well, this is what we want to do, you know, we are going to develop, we are going to do this, we are going to do that, and let us make the decision whether it fits with something that we want to do. And I know that all three of your businesses would do that because you're experienced, because you do this, you know, and have been doing it for longer than anybody really. We don't always get that, I think, from everybody else. So I think that's really important to note. But from my perspective, I think it'd be interesting to see what the high street looks like. Somebody was talking the other day about having a kind of continent bistro, outdoor dining kind of feel to it, you know, where you sort of go to Venice and it's all outside and stuff, which would be great if it didn't rain all the time in the UK. So we'll see.
Lots of umbrellas and
yeah,
no, I think we'd already seen a start of that pre-COVID. You know, if you go down the high streets, whether it's Altrincham, as Jason said, or any of the towns outside of London, and you'd already started to see the majority of retail space that was doing well was coffee shops, restaurants, and dare I say it, charity shops, and much of everything else was struggling or moving towards an online arena. COVID, as I said, as you said, Emily, has accelerated that. I don't think it's maybe changed the direction as much as people think, but it's accelerated the process. You know, is that a good thing or a bad thing? I don't really know. But you know, the high street has started adapting to it, and we're seeing differences in towns. And because it's been accelerated, because it's not now the evolution that Lucy said it was for many, many years, it becomes more noticeable because it's happening quicker.
I was going to ask as well, because the move away from office-based working, which again, we don't know how permanent that's going to be, and I know some people have started going back, but presumably that's opened up certain stock, if you like, on certain high streets or other areas. Does this impact the availability of investment options for people looking to get into semi-commercial, because some of this might become available now, vacant?
I think we need longer to really understand, you know, what businesses are going to do with their office space. I have a personal opinion on it. You know, I don't know what the other guys think, but I think give it a year and we will see people back in the offices pretty much full time as we were. Maybe a bit more flexibility, but ultimately, you know, people are the majority of people are more effective when they work in an office, and they need to for their job.
I was about to say that, and I think that it's definitely too early. And whilst there are some vacant offices, I personally haven't seen that much. Even when you go into London now, it's busy again. Okay, capacities are probably lower, but I would say from September, nearly all businesses have some sort of presence back in the office. And I think the bigger businesses have found it harder to go straight back to full-time office working, for many reasons that would take too long to get into the debate on this call. But the reality is, offices, I think, are essential for businesses. I think home working, flexibility, that's all a big debate, but I don't think you can recruit, train and effectively have a team of people especially in our type of business. I mean, you need collaboration, and okay, you've got Teams, you've got Zoom, but that you need to set aside time to actually do those calls. What you don't get is the hearing what other people are saying. You don't get to pick up on conversations, and I think it's too embedded in our culture for an 18-month period to completely revolutionize the way that we work. The flexibility point is something slightly different, but I don't think offices suddenly become obsolete. And actually, there was a huge shortage of offices before the pandemic because there was so much going to residential. Certainly in town centre locations, we're based in Gerrards Cross, and nearly every office building was turned into flats in the town centre, which then pushes people further out into business parks. And I think, therefore, the shortage of offices will probably offset slightly the reduction in capacity demand. So offices may take smaller premises than they would have done before, because they might decide to embed the flexible working in. Some will, some won't. I still think the principle of requiring office space will very much be there into the future, and it's still such early days. I think there's still a bit of a shock from the pandemic. People haven't really had a chance to catch their breath and work out what happened, why, and if it's ever likely to happen again, and should they base their plans around it, or actually was this just a point in time that we'll all look back on and say, wow, that was pretty crazy, but on we go. So I'm sort of with Emily on that. I don't believe that that's the death of offices or anything like what we saw in the retail sector, because I think people still need a place to work, and it's not practical for everyone to work from home.
Yeah, I mean, it's interesting, isn't it? Because I think, you know, strategically, we've gone from probably being very specific in our thought plans around having a huge head office location. And as we've gone through the last 18 months and we've seen how efficient remote working can be, we've been blessed to recruit new talent, which maybe we wouldn't have been able to recruit if we'd have had that one location. But you know what, these people who've joined and have demonstrated huge talent, there's still a togetherness, there's still a team kind of dynamic that they crave. So we're probably, well, not probably, we're in a strategic position now where we'll probably have some satellite offices. So we'll keep our central location. We don't need to expand the floor space, but we'll have strategic locations around the country where our staff can actually get together and still feel part of a united team and still do the knowledge sharing, which Lucy intimates is so crucial. So I think businesses will pivot, but certainly the idea of our staff working 5 days a week from home is we'll offer flexibility, but we want to support them by having some strategic satellite locations.
Okay. That's always a topic that gets people going. I'm sorry to have introduced that right at the end. We've only got a few minutes. That was really flown by. I want to go to each one of you just for some closing comments. But Emily, I'll start with you. But if you wouldn't mind running through just the criteria from InterBay for these products, because we always get questions at the end or after the session where everyone's like, I just want your standard sort of criteria or something that you can run through with us very quickly to leave our viewers with a concrete understanding of what sort of products you've got. That would be great.
I'm testing my technical knowledge here. Thank you for that. I will caveat and say that we have a team of fantastic BDMs who have national coverage. So if you do need any more information, then do give them a ring. But basics criteria. So we lend up to 70% LTV, and the rates currently are fairly competitive. The biggest sort of the kind of general USPs, I suppose, with InterBay, so we lend to trading businesses. We are happy to consider, complex structures along the lines of SIPs, trust, things like that. Specifically semi-commercial, we don't have any kind of minimum split on the resi or commercial. So again, that kind of makes life easier. And I guess the main things, as I said, we want to know what the asset is and who we're lending to. And as long as we can build a good picture of the client and the property that gives us some comfort for sustainability going forward, then that is essentially what we need. So we will be flexible. We still have our credit committee. So we are still very much in the business of taking things into credit. That I don't think I'm allowed to talk about credit committee, but I'm going to keep going with it. Anything that doesn't fit on the black and white policy that you see, we're more than happy to have that conversation and ultimately see if we can look to lend. We want to take a very much of a boutique approach to lending. And again, as I said before, it's why we work with the guys that are also guys and lady that have joined us today, because we know that the knowledge they have is absolutely vast. So we're really comfortable dealing with them, that they know what they're on about.
Thank you very much. Matthew, any closing comments from you before we bring this to an end?
Not really. I mean, I've said it before. I think with any business, I think diversity, agility, and margin are the things that will keep a business robust, whether that's property or anything else. And semi-commercial and all specialist securities, whether it's HMOs, multi-unit freehold blocks, but semi-commercial offers that increased yield, that increased margin, and it offers diversification of portfolio. And I think any landlords, the days of either landlords investing down south looking for capital appreciation or investing up north looking for yield, I think those days for the committed landlord should be gone. And I think they need to be making sure that if we have periods of stagnant property prices, which we could easily find in certain areas if we see a correction in prices down the line, that their assets are working for them and generating yields that are comparable across the other areas where they could invest those funds, and whether it's specialist brokerages such as Lucy's, Jason's, or our operation working with specialist lenders, it's that collaboration with clients, that education piece Jason talked about, that's going to be important going forward.
Thank you, Matthew. Jason, final thoughts from you?
Yeah, probably just building on that, two elements from me, I suppose. So the education bit is absolutely crucial. So we're committed to working with InterBay and the OSB brands to just ensure these webinars, these blogs, these emails with case studies. So we just build the momentum that's required to help brokers who have maybe not got the knowledge, not got the understanding, but are craving the next opportunity, because we believe this this semi-commercial, it's a wealth creation product for investors. So wealth creation, but it needs explaining, there's no doubt about it. We're passionate about property, and we're passionate about making sure when we present the cases across to InterBay or any of our lending partners, we get it right first time, and we're enthusiastic about the positioning of the case. So we save brokers time, and we deliver conversions and high levels of conversions, but really committed to this space.
Thanks, Jason. Lucy?
Yeah, I suppose it probably does fall again under the education topic, but for us it's about it's not necessarily purely criteria driven. It's asking the questions that people don't necessarily think to ask, and understanding both client and property really, really well. Because for me, criteria is usually a guide. There are some lenders who have quite black and white, it either fits or it doesn't, but we work with lots of lenders like OSB who take a more pragmatic view, and it's a case of trying to pick out all the merits, but as well as that, looking at the risks. There's no point just selling a deal and telling everyone how great it is, and then when they want to talk about the drawbacks, you try and breeze over them, because they will come out in the wash. So for us, we sort of look at it in balance and say what's good, what's bad, strengths, weaknesses, and does it balance out to being a credit-worthy application? And if it does, then we make sure that we present that in the right way. We often get asked, what are the rates? What's the loan to value? And we often have to go back and say, I'm sorry to answer a question with a question, but that's what I'm going to have to do here, because it's very, very case specific, and it takes understanding a multitude of different transactions, but having had the experience of what can go wrong, what can go right, to be able to ask those questions in the right way, and then be able to present it back to the lenders that we work with, to fit somewhere within their criteria, but to a point where they can look at it and say, I can see why that makes sense. If you leave questions unanswered, it gives people the opportunity to fill in the gaps with their own preconceived ideas, whereas if you actually present everything, you've sort of done part of the job for that underwriter, and I think that makes it a lot easier for everybody then, and the outcomes are far more positive that way.
Thanks, Lucy. There's lots of fodder there for a part two, I think, but we have come to the end of our time now. Thank you very much to Emily and to InterBay for supporting today's roundtable. I think it was a really good conversation and a good foundation for people listening who perhaps they may be experienced or they may be amateurs, as Lucy had mentioned at the top, that there are a few people looking at this market that may not know too much, but I think they certainly do know a bit more now. Thank you, Jason, Lucy and Matthew as well for bringing your expertise as per usual. This roundtable will be available to watch and to catch up on next week on Bridging and Commercial, and we'll also be doing a short roundup of some of the highlights and most salient points. But thank you very much to everyone who tuned in and watched, and thanks again to our panel. Enjoy the rest of your day and your week.